Hello and welcome to this video series starting today on FRA Financial Reporting and Analysis. Comprises of 20% on the exam. Extremely important topic, very easy and extremely calculative intensive, and that's good because as we Indians have this habit of of relating things better to numbers. Jahan bhi number aa gaya, we feel more confident, we feel more attracted towards the topic. Before moving deeper into the topics, I'd give a highlight of what FRA at CFA program looks like. If you are a CA, you are a CS, okay, you are a CPA, okay, you are doing some other courses. If you're a BCom graduate, if you had 11-12 commerce stream, okay, it's gonna be a very simple topic to you, obviously. But if you have not been exposed to accounts and all earlier, don't worry, we'll take it from the scratch. FRA is one topic where I believe I've tried to add as much as value as possible, taken a lot of examples, taken simple numbers, okay, left behind the derivation of different formulas, okay, and given important key takeaways at the end of difficult lessons, okay. So just to give you a feeler, okay, at accountancy, at FRA, okay, it is not about debit and credit. It is not about preparing the financial statements. That is done by the accountant, by the chartered accountant, okay. You as a financial analyst, okay, will be there, are there in order to analyze a particular company. In fact, this 20% weightage is what I feel underweighted, because FRA will help you at equity investments, is going to help you in bond valuation, is going to help you in corporate finance, okay. So just 20%, I feel it has a weightage of around 30%, if you see indirectly, okay. So in terms of, as the name suggests, financial reporting and analysis, FRA, okay, your work as a financial analyst needs to be to analyze the financial statements and then come up with a recommendation of whether or not your client needs to invest his corpus into that particular investment vehicle, into that particular company or not, okay. Generically speaking, I'll be taking 4-5 minutes more to explain to you the broad theme, okay, and then we'll directly jump into the LOSs, okay. So broadly speaking, the value of any company can be described as cash flow divided by the discount rate, okay. The intrinsic value of any asset, an asset in finance is anything whose value we derive after discounting the future cash flows. The future cash flows can be anything. It can be interest, it can be rent, it can be free cash flow to equity, it can be free cash flow to the firm, it can be the proceeds on sale, it can be the maturity value in case of bond valuation, okay. So any future cash flows for the value of an asset in finance. An asset is called an asset in finance because of its ability to generate future cash flows. For that, we need to forecast the future cash flows. So given the financial statements of a company, okay, given the strong potential, the management quality, the legacy, the business environment, the industry, the economic scenario, we as analysts need to come up with those projected future cash flows, and FRA is going to help us do that. We also talked about intrinsic value being the future cash flows divided by the discount rate. Now, while considering the discount rate, we need to consider the operating risk of the company. We need to consider the financial risk, the capital structure analysis, the debt equity ratio, the solvency ratios, the activity ratios of the particular company. We need to look at the growth potential of the company going forward. We need to look at whether or not the company is able to sustain its growth over the future, whether the past, okay, whether or not the management has improved the past, whether or not the management is working towards diversifying the product lines, okay, whether or not the management is completely honest, has a great integrity in them, okay, the board of directors, okay, are not aligned with the management. All this analysis is financial reporting and analysis. Then the financial reporting and analysis dives deep into the different financial statements, where we'll be dissecting each financial statements, the financial statements, namely income statement, balance sheet, cash flow statement, and statement of changes in owners equity. Okay, we'll be dissecting all these financial statements, understanding the importance of a provision for bad debts. What happens when suddenly the provision for bad debt percentage has increased from 5% to 7% this year? What has happened this year? Is the management trying to window dress? Is the management playing around with the US GAAP or IFRS in terms of preparation of financial statements? Whether it's changing the depreciation on a regular basis, the depreciation method from WDV to SLM to production units method to this and that, is it doing all that earnings management? This is a part of financial reporting and analysis. At BCom level also, okay, there are curriculums where a topic known as financial statement analysis is there, and trust me when I say that it's completely disrespected there. We are just supposed to calculate ratios, randomly write any interpretations and all, and that is not here what you'll be doing at the CFA program. Here we'll be having lot of sophisticated discussions, and I feel that the value we've added, okay, is totally real life oriented, application oriented. We've obviously kept in mind the primary objective is to cover the learning outcome requirement, okay, as laid down on the slide. But not just that, okay, we are going to take real life scenarios. In fact, when we do understanding income statement, balance sheet, cash flow statement, okay, we'll be showing you real life income statements and balance sheets of different companies and how to interpret that, the capital structure analysis, whether the bonds that have been issued by the company, what are the scenarios. The other day we did a reading on currency exchange rates, right? So if a company is present in 10, 12, 15 geographies, so whether or not the financial analyst needs to forecast the exchange rate of those geographies and see whether the company has taken measures to hedge itself against those possible and probable currency adverse effects. All that discussion is gonna be done here. With this little introduction, let's directly move into the LOS requirement. The first LOS says, describe the roles of financial reporting and financial statement analysis. As the name suggests, financial reporting refers to the preparation of financial accounts. It refers to providing information to both internal and external parties about the company's financial performance, that is the income statement, financial position, that is the balance sheet, and the changes in financial position as expressed via the cash flow statement. On the other hand, the role of financial statement analysis is to assess the performance of a company, is to assess the management quality of a company, is to evaluate the future prospects using different financial models, using the news, the information that the company has released with itself. Okay, it refers to evaluating future prospects using financial reports and other relevant information with respect to the industry, the economy, and the company in specific. There needs to be assessments, okay, that need to be performed before making investment decisions and putting our clients' money into the stock of a particular company, or whether the bonds issued by Reliance should be bought by our client or not, whether or not Reliance is in a position to service its debt, whether interests will be paid on a timely basis or not, and whether or not 5 years down the line during maturity, okay, our bonds would be redeemed or back or not, whether or not the company will default. It sounds really exciting when I say it, and I'm sure you acknowledge the fact that, but the more deeper thing is, doing this in real life is really difficult. Okay, making economic decisions related to a company, making investment recommendations related to a particular asset class, okay, not just a company, okay, it might be a private equity fund, a hedge fund, okay, a private limited company, okay, analyzing all that, okay, then how to manage currency, okay, if a company is a conglomerate and it's present in different geographies, how is the recording for multinational operations done? all this, okay, is discussed at financial reporting and analysis. Obviously, the entire thing which I have talked about is not only spread across different subjects. Okay, for example, now we might understand what financial statements are, but when you do equity, we look at the valuations, okay, and the multinational operations, the currency exchange rate, the forecasting, and this and that might be a part of the level 2 curriculum and the level 3 going ahead. So it's not just right now, okay, it's also about going ahead, and it is clearly very very important to have a good base here. Students who are having an accountancy background will definitely have an edge, but I assure you we'll go very very slow, okay, and try to incorporate students, okay, who do not have any prior accountancy background and take topics directly from the scratch. A company's performance can also be examined through the profitability. Profitability means the ability of the company to generate future cash flows, to generate profits from the core business activities, and the ability of the company to generate cash receipts in excess of its payments. Okay, a forecast of the expected amount of future cash flows is actually very very important in determining whether company will be able to meet its future obligations. That is reflected by the liquidity and the solvency position of the company. Okay, so this is the role of financial statement analysis. Okay, before without saying, I just get excited. Okay, it's one of the great topics. Okay, and I love to speak more, okay, but it's actually a very small topic. There are around 8 or 10 end of chapter questions, practice problems, a couple of questions we've added from other materials, so this reading shouldn't take you more than 1.5 hours, okay, to to do. So small reading, listen to my lectures of some time, and then directly jump into the questions. The companies prepare financial statements to report the operating performance to investors and creditors. That's financial reporting. But for financial statement analysis, you need to be properly, well versed with understanding or interpreting the financial, reports. Okay, in order to forecast financial performance of a particular company. There are a couple of elements of financial statements. Okay, the elements of financial statement includes an income statement, which is the statement of changes in financial position, a balance sheet, which is the statement of financial position. Okay, and then after that we have something, in fact, income statement is a statement of financial performance and balance sheet is a statement of financial position. We after that have something known as a cash flow statement, and we finally then go to statement of changes in owner's equity and financial notes. So these 5 are elements of financial statement. At BCom BBA class 12 level, we are taught only 3 statements. Okay, balance sheet, income statement, cash flow statement. Okay, but there are 2 other statements: statement of changes in owner's equity and notes to accounts and financial statements. Okay, so those are also a part of the financial statement, and they come under the financial statement umbrella. So let's first go to the income statement. The income statement is a simple statement, also known as the statement of financial performance. It provides operating information with respect to the company's business activities over a particular time period. Okay, generally it's prepared for a year. Okay, so the income statement presents the revenues, the different sources of revenues that by which the company has earned revenues, the sales, the other incomes. Okay, and then the corresponding cost, the raw material cost, the rent, the salary, the advertisement cost, the marketing cost, the sales and distribution costs. Okay, and the difference, on a simplistic note, okay, the difference between the revenue and expense is the net income for the company. Balance sheet, on the other hand, also known as the statement of financial position, presents the company's assets, liabilities and equity at a point of time, and therefore it is known as a statement of financial position because आज के date पे क्या है वो दिखा रहा है. Okay, and the relationship between the 3 variables that I talked about, assets, liabilities and equity, is shown on your screen right now. And this assets equals to liabilities plus equity is also the basic accounting equation. The first, what do I say? In fact, this is where accounts start. Okay, if I can put it that way. And the information contained in the balance sheet is used to assess the company's financial position and whether or not the company will be able to meet both its short-term and long-term obligations. We then move on to the cash flow statement. The cash flow statement reports the various sources of receipts and cash payments. This statement classifies the uses and sources of cash into operating, investing, and financing activities. Operating activities, as the name suggests, refers to the day-to-day core business activities of a company. Investing activities refers to the acquisition and disposal of fixed and long-term assets. And financing, as the name suggests, refers to the financing activities refers to borrowing as well as repaying those loans. It relates to injection or repayment of capital. The cash flow statement reflects a company's ability to generate cash from its core business activities. It is desirable that a company generates most of its cash from operating activities as opposed to investing and financing activities. Why is that so? Because as an investor, have I invested in Tata Motors because of its ability to generate, or because of its ability to take loans, because of its ability to service those loans, because of its ability to acquire land at cheaper rates, or its ability to design and sell more and more cars, be updated with the market trends, be updated with what the customer preferences is? We have because of that activity, and that is the operating activity. So as a financial analyst, I would love to see that the major component of cash is coming from operating activities. However, business is not done in a vacuum, and therefore investing and financing activities also take place. But will I want to see that the company is making profits by selling off land that it already acquired at a historical cost? Will I be wanting to see surplus cash that the company has been able to take from a loan? No, we do not want to see that. We want to see that the company sells cars and makes profits, exports, expands in different geographies. Okay, so therefore it is desirable that a company generates most of its cash via operating activities. A company's source and use of cash provides valuable insight into the liquidity, solvency, and financial flexibility of the company. If we move on to the statement of changes in owner's equity, this statement reports the changes on owner's equity over a particular time period. It is useful to understand the changes in the financial position of a company. As in, at the end of the year, I had 100 million shares outstanding worth 10 rupees each. Okay, so in the balance sheet at the start of the year, so I had 1,000 million worth of equity shares. At the end of the year, I came out with a FPO, that is a further public offering. Okay, and I issued another 10 million shares worth rupees 10 each. So my entire share value has increased to 1100 million. So simplistically, obviously there are complications involved here, okay, but on a very simplistic note, this whatever I have talked about, okay, it refers to what is known as change in equity, and a statement that exhibits all this in a very professional and a gap oriented fashion is known as the statement of changes in owner's equity. I also talked about financial notes, okay, and supplementary information. Okay, so these notes are important part of financial statements because they provide explanatory information about the following aspects: the accounting policies, the methods, the estimates, the business acquisition, disposals, commitments, the legal proceedings, the subsequent events, the related party transactions, the business and geographic segments, the financial instruments and risks arising from them. All these aspects, okay, whether or not we've received money by our creditors, how long will we take to pay money to our creditors, okay, whether or not we have been able to service our debt on a timely basis, okay, all that information is provided here. Whether what accounting depreciation method am I using, what method to record financial assets am I using, what method to dispose assets am I using the market value or the cost or the net realizable value, what exactly am I using? All those information have been provided in the financial notes. Okay, they also contain important details, okay, about the estimates and assumptions that the management, that the accountant use is to prepare the financial statements, okay, and the company as well. For example, the choice of revenue recognition method and the assumptions are made. Okay, so that clearly will help an analyst to forecast the financial statements and also try to understand whether the management is playing around with the investor community, or whether the management is very honest and portraying the picture in a very what do I say, in efficient and honest manner. We also have something known as a management's discussion and analysis. As the name suggests, this section, okay, is required under US GAAP. Okay, it highlights the trends and the effects that affect a company's liquidity, the capital position, the operations, whether or not the management wants to invest into a different business. Okay, what are the upcoming projects for the particular year, what are its views with respect to the inflation, price of raw materials of their industry, of their inputs, the future goals, the uncertainties, what exactly is the management's take, what is the contingency related measure that the management has absorbed in its internal control system. Okay, it is also critical to accounting policies and requires the management to make subjective judgments and decisions that have a material impact on the financial statements. Okay, all that is discussed in MD&A and A. We now come to LOS-D. Okay, the financial statements presented, okay, in a company's annual reports must be audited. What does audited mean? The financial statements are presented, are the financial activities that take place are within the company, but whether or not there is any material misrepresentation in those financial statements or not, that needs to be verified. So auditing refers to verification of the financial statements, the transactions, the activities, the cash flows, the expenses, the revenue, different types of expenses. Okay, it refers to verification of that expense. That is known as auditing. And obviously verification has to be done by a third party in order to have credibility for that verification, for that audit. Thus, the financial statements must be examined by independent accounting firms, chartered accountant firms, okay, which then states the opinion on the financial statements, that whether the financial statements are clean, whether the financial statements have some material misrepresentation, and so on and so forth. And unlike GIPS, okay, which was not mandatory, which was recommended, here audits are required by contractual agreements by the law. So, what exactly are the objectives of audit? Under the IAS, International Standard for Auditing, objectives of an auditor or an auditing firm include to obtain reasonable assurance whether the financial statements as a whole are free from material misstatement, whether or not there is any fraud or error committed while presenting or preparing the financial statements, and the financial statements, the material provided, the information provided are material in all respect, and they are in accordance with the applicable framework. Okay, for example, the financial statements, the balance sheet, income statement must be prepared in accordance with accounting standards, the specific schedules. Okay, the depreciation must be charged in accordance with accounting standard 6. The cash flow statement must be prepared in accordance with accounting standard 3, cash flow statement. Okay, similarly, goodwill, how should goodwill be treated? For that there is another accounting standard. So whether or not that the financial statements are prepared keeping in mind all that, okay, obviously, okay, it is better that the financial statements are prepared and audited by different entities. Generally it's the company's job to prepare financial statements, but sometimes they outsource the job. Okay, so obviously they should not outsource the job to their auditors only, to the chartered accountancy firm only. There should be a complete firewall between the two divisions, so as to keep the integrity and the veracity of the financial statements intact. The second objective is to report on the financial statements and communicate as required by the ISA, the International Standards for Auditing, and communicate with respect to what the auditor has found. We next come on to audit opinions, the types of audit opinions. Okay, what is a qualified audit opinion, an unqualified audit opinion, a disclaimer of opinion, okay, an adverse opinion? What exactly is that? We'll be discussing here. An unqualified opinion states that the financial statements are prepared unbiasedly. They are prepared in accordance with applicable accounting standards. They are prepared in a proper and a good and a decent and an honest way. That is an unqualified opinion. Excuse me. So, a qualified opinion, on the other hand, states that the financial statements have been presented fairly but do not contain exceptions to the accounting standards. But do contain exceptions to the accounting standards. The audit report further, will provide details and explanations relating to those exceptions. An adverse opinion states that financial statements have not been prepared fairly and the management has done some bias in the entire year. They have deviated significantly from the acceptable gap, from the acceptable generally accepted accounting principles, the accounting standards. Okay. And finally, a disclaimer of opinion is issued by auditor. For whatever reason, he is not able to have an opinion on the financial statements. He's confused. He is not sure whether the financial statements are correct. The management has done something which makes it very inconvenient for the auditor to review and audit the financial statements. Before this, there is something known as an internal control system. Okay, the internal control system of a company seeks to ensure the reliability of the processes that are in place at the company and that help in the preparation of financial statements. Okay, for example, in the United States, the management of a company is responsible for the effectiveness of an internal control as well, to evaluate, whether the effective control has been properly implemented or not, to support the evaluation, and also provide a detailed report on the internal control systems present in the company. Obviously it was US specific, so I did not put it on the slide. Okay, and there are places where you might have noticed that my slides and explanations are a lot more, but that's the way it is. Okay, so I've tried to do that, and therefore I advise, request, order you to take down a copy and write all important points, take down notes. Okay, and I sometimes tell you also to take down this point, but always it's not possible. Okay, but I request you to do so. We now move on to interim reports, as in LOSE actually, which speaks us to identify and describe information sources that analysts use in financial statements, statement analysis, besides annual financial statements and supplementary information. So here there are a couple of bullet points. Firstly, it's an interim reports. Interim reports are prepared by the management either annually, are prepared either semi-annually or quarterly. Okay, they contain the 4 financial statements and the footnotes. Okay, but they are not audited. Proxy statements, they are distributed to shareholders when there are matters that require their vote. They provide information about the management, the director compensation, the stock performance, the ESOPs that have been issued, potential conflict of interest between the management and the board of directors. Okay, all that. Press release refers to an information that has been provided on the company's website, the conference calls, and other information. It also provides current information about the happenings in the company, what the company is doing, and so on and so forth. Finally, we have something known as external sources of information. Okay, those information provide information about the economy. Those sources provide information about the economy, the industry that the company operates in, the competitors of the company. And actually, to be very honest, this information is much more important. Okay, because it helps us to analyze. It helps an analyst to analyze, okay, the surroundings and put the company's performance into complete perspective. Okay, trade journals, government agencies, okay, associations of different industries, the publications by the Chamber of Commerce, the Ministry of Chamber and Commerce. Okay, all that come under external sources. This is it for this reading. I urge you to understand the entire process of preparation and analysis of financial statements. This was perhaps the most important reading which I feel going ahead in FRA. Okay, and you also have got a perspective of why financial statement analysis, financial reporting and analysis is done. Okay, and keeping in mind, best of luck to the end of chapter questions, the questions that we've provided in handouts. Okay, go through the summary of the core readings. Okay, summary here is excellent. They've tried to provide all information possible. Okay, and then get back to another exciting reading on FRA. Thank you and best of luck. This is Akash signing off.